All right, it's January 30th, 2026, and if you care about silver, if you're watching macro, or honestly, if you just want to understand how fast leverage can absolutely demolate a market, you need to stick with me for the next few minutes. Because what just happened in silver wasn't a pullback. It wasn't a correction. We're talking over 30% erased in what felt like 48 hours. Silver went from around $121 an ounce down through 85. That's not noise. That's a structural break. And here's what you need to understand. The real trigger wasn't just silver selling off, it was Trump floating Kevin Warsh as the next Fed chair, which immediately shifted rate expectations, strengthened the dollar, and basically lit a match in a market that was already stretched, already leveraged, already parabolic. I'm going to show you not just what caused this crash, but how to recognize this exact setup the next time it's building in real time. If you're holding physical, if you're trading futures, if you're just watching from cash, your job right now is to understand the mechanics. Because this pattern repeats, and it's going to repeat again. Before I explain what actually caused this thing to implode, let me teach you something about silver that most people don't really internalize. Silver isn't just a metal you buy and hold. It's a leverage instrument wearing a metal costume. The paper market, the futures market, is absolutely massive compared to actual physical supply. And when price starts going vertical, leverage builds quietly in the background. You don't see it until it breaks. Think of it like stacking chairs higher and higher on a slippery floor. Everything looks stable. Everything feels fine. Until someone bumps the table, and when that happens, it's not one chair that falls. It's the entire stack collapsing at once. That's why silver never gently corrects. It doesn't drift lower over weeks. It spikes, it squeezes, and then it air pockets. It falls through floors that looked solid just days earlier. So what does that tell us? It tells us that when you see silver ripping higher on momentum, you're not just watching demand. You're watching leverage accumulate. And leverage always unwinds violently. Now here's what's actually happening under the hood. Let me break down the sequence for you because this matters. First, the Warsh nomination hit the tape. Markets read it as more hawkish than expected. That's critical. More hawkish means higher rates for longer. It means a stronger dollar. And non-yielding assets like silver absolutely hate that combination. So you get the first wave of selling. Money rotates out. That makes sense, right? But here's the thing. That alone doesn't wipe out 30% this fast. What happens next is what most people miss. Once silver started slipping, margin requirements didn't care about your thesis. They didn't care if you thought silver was going to $200. Futures traders started getting margin calls. Forced selling kicked in. Stop losses triggered. And liquidity, which was already thin because everyone was long and leveraged, basically vanished. Once liquidation starts in a market like silver, it feeds on itself. So when the trigger hits, here's the cascade. Price drops 5%. Leverage starts to unwind. Funds have to sell positions to meet margin. That selling pushes price lower. Lower prices trigger more margin calls. More margin calls force more selling. It's reflexive, it's mechanical, it doesn't care about fundamentals, and the confirmation is right there in the data. Open interest is collapsing while volume is exploding. That's not investors calmly changing their minds about silver's future. That's positions being blown out of the water. That's forced liquidation. But here's the part that should make you pay very close attention. While paper silver is absolutely flushing, physical silver isn't behaving the same way at all. I want you to hear this clearly. Shanghai pricing is still trading near $120 an ounce. Let that sink in. That's a 40% premium over the paper price. 40%. That tells you that price discovery is completely fractured right now. The paper market is saying $85. The physical market is saying $120. What does that mean? It means this move is driven by leverage unwinding in the futures market, not by a collapse in real-world demand for the actual metal. Physical buyers aren't running away. They're still paying massive premiums. That divergence is everything. And this is the exact same playbook we've seen before. I want to give you context here because patterns matter. Every single time silver goes parabolic on leverage, the unwind looks violent, not orderly. Let me take you back. In 2008, during the financial crisis, silver collapsed over 50% as leverage unwound across the entire system. Physical demand stayed strong. Dealers couldn't keep product on the shelves. But the paper price got absolutely destroyed because leverage positions were getting liquidated. Same story. In 2011, after silver hit nearly $50 an ounce, after that blow-off top, it didn't drift lower. It fell down an elevator shaft, dropped 35% in days. Why? Margin hikes, forced selling, leverage unwind. March 2020 did the same exact thing. When COVID hit and liquidity froze, silver dropped 40% in 2 weeks, even though everyone knew stimulus was coming and metals would eventually benefit. Same pattern. When you zoom out, you see it clearly. Silver doesn't crash because demand disappears. It crashes because leverage does. The fundamentals don't vanish overnight. The leverage does. Now let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this just be manipulation? Could big banks be pushing the price down on purpose? Look, I'm going to be honest with you. Focusing on that doesn't help you trade. It doesn't help you protect capital. The tape tells you what matters. When leverage builds to extreme levels and a macro trigger hits, silver breaks. Period. Whether it's intentional or mechanical doesn't change the outcome. The more useful question isn't who did this. It's what conditions made this possible. And here's the thing. You can control how much leverage you use. You can control your position sizing. You can control whether you chase parabolic moves or wait for pullbacks. Focus on what you can control. The mechanics are what matter. There are probably 3 types of people watching this right now. Let me speak to each of you directly because your situation is different. First, you might be a long-term physical holder. You've been stacking silver for months or years. You believe in the thesis, and this price action probably feels really confusing to you. Paper price is collapsing, but when you check dealers, availability is tight and premiums aren't budging. That tells you exactly what I just explained. This move is paper-driven. It's not a collapse in real-world demand. If you're holding physical and you weren't using leverage, you're actually fine. Your metal didn't disappear. The paper market is just recalibrating. Your job is to stay calm and remember why you bought in the first place. Second, you might be a trader who got caught chasing the breakout. Maybe you bought silver at 110 or 115, thinking it was going to 150, and now you're sitting on a massive loss. If that's you, don't beat yourself up. This market punishes late leverage. It always has. The lesson here isn't that silver is done or that the thesis was wrong. The lesson is about timing and position sizing. If you're over-leveraged, this is your wake-up call. If you survive this, the next time silver runs, you'll know better. You'll take profits on the way up. You'll use stops. You'll respect the volatility. Third, you might be sitting in cash right now. You've been watching silver run and you didn't chase. Maybe you sold earlier. Maybe you never got in. And now you're wondering, is this an opportunity or a trap? For you, patience is the edge right now. Let the forced selling finish. Let the volatility compress. Let the weak hands get flushed out. The best entries don't come when everyone's panicking. They come when the panic exhausts itself and price stabilizes. So here's what I want you to answer in the comments. Which one are you? Are you holding physical? Did you get caught long? Or are you waiting in cash? Because the universal principle here is simple. Silver rewards preparation, not prediction. It rewards patience, not panic. So here's where I stand. I'm not panicking, and I'm not blindly buying either. I'm watching signals. Let me tell you what I'm personally watching right now. First, I'm watching the $85 to $80 zone. If we see panic continuation through that level with accelerating volume, that tells me we haven't found a floor yet. Second, I'm watching $70 to $75 as deep washout support if liquidation really accelerates. That would represent a full retracement back to pre-breakout levels. Would I be surprised? No. That's what leverage unwinds look like. Third, I'm watching physical premiums very closely. If they stay above 25%, that tells me downside risk remains paper-driven, not fundamental. The moment those premiums collapse, that's when I'd start worrying about actual demand destruction. Based on my analysis, this crash was mechanical, not emotional. The fundamental picture for silver hasn't changed. You've still got massive fiscal deficits. You've still got geopolitical uncertainty. You've still got industrial demand for solar and electronics. You've still got central banks buying gold, which lifts the entire precious metals complex over time. None of that vanished in 48 hours. What vanished was the speculative excess. What vanished was the leverage. And honestly, that's probably healthy long-term, even though it feels brutal right now. If history rhymes and silver absorbs this selling and starts to base, the move that follows could be just as violent to the upside as this crash was to the downside. But we're not there yet. We need stabilization first. I'm not a financial advisor. This is not financial advice. I'm showing you how I'm thinking through this, but you need to do your own research and make your own decisions. If you made it this far, you're part of a rare group. You're someone who wants to understand markets, not just react to them. That mentality will serve you well, whether you're trading or holding. If this breakdown helped you see the mechanics more clearly, do me a favor. Share this video with someone who needs to hear it. Subscribe if you haven't already, because I'm going to keep breaking down these patterns as they develop. The people who stay ahead aren't the ones with the most capital. They're the ones who recognize the setup before it breaks. Stay sharp out there. Verify your data. Think critically. And make decisions, not reactions. I'm going to show you not just what caused this crash, but how to recognize this exact setup the next time it's building in real time. If you're holding physical, if you're trading futures, if you're just watching from cash, your job right now is to understand the mechanics, because this pattern repeats, and it's going to repeat again.